how does implied volatility enter the market? When uncertainty enters the market, whether it's a bank failure or an FOMC event that's planned, that presents uncertainty in the market, right? And it's not necessarily a price drop or a price increase. In other words, the market moves. It could be news related or an impending event. And so how does it manifest itself in the options market? Is it going to show up in higher demand in the 60-day series, in the 30-day series, in the front month, in the front cycle? Think about it that way. Where is it happening? And the way it's going to happen is think of it like a wave. That implied volatility is, if you're thinking about it correctly, obviously going to come in the closest cycle to expiration. So we have weeklies, right? I think in the SPX are darn near every single day. So that series is going to be impacted from the uncertainty up until when that, if it's a news event, the FOMC or earnings, you'll see that in stocks. You're going to see the implied volatility is going to come into or impact the cycles or option expirations in the front first. And then at a decreasing rate, they're going to impact expiration series further out. Understanding how far that wave, if you will, comes into those expiration series and how much it impacts them is critical to understanding calendars. And then the reverse is when that uncertainty passes, how is that wave going back out to sea, so to speak? How is that rate of change impacting the front cycle and back cycle? Does that analogy make sense, John?
Yes, it absolutely makes sense. And when we did implied volatility for Ultimate Income Trader, I had a suitcase I was throwing at people in the crowd. I said, I picked it up and said, "Who's most concerned about getting hit by this suitcase?" And the people in the front row are like, "Right, well, we are." Right? Back row says, "We're not concerned at all because you can't throw that far. We don't believe in your strength." Right?
Exactly.
Right. So it's the same thing.
Yeah, and so real simply put, if you could take advantage of uncertainty coming into the short that you're going to sell, which is the front cycle of the calendar, and then that implied volatility doesn't impact your back long that much, that would be what we would consider an optimal situation. So if you can think about how implied volatility or uncertainty enters the options chains like a wave going in and out in the ocean, I think it really helps to set the visual of what's happening.